Hi everyone, welcome back to the YouTube channel of EPK Capital Consultancy. On this channel, we talk everything about finance, investment, and wealth management. And in the near future, we will also start digressing and understanding more about the investment products that would be available in the market at that point of time. In this video, we are going to understand about what are mutual funds, different types of mutual funds, and what is the main difference between mutual funds, PMS, and equity. So without wasting any more time, let's get into it. At core, a mutual fund is a professionally managed investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, or any other asset classes based on the investment strategy of that particular mutual fund. In different parts of the world, mutual funds are regulated by different regulatory bodies. For example, in India, mutual funds are regulated by Security and Exchange Board of India, which is SEBI, and mutual funds are managed by asset management companies, or the short form AMCs. In mutual funds, investors purchase units, and the value of these units is calculated based on the net asset value. In some other video, we would be understanding more in detail about how NAVs are calculated and how the units are allocated. But for now, let's continue with our video. So, based on the net asset value of the mutual fund, which is the total value of fund's asset minus liability. Main advantage of mutual fund is that mutual fund provides diversification as they invest in a wide range of securities, which helps to spread risk. Mutual funds can be open-ended or close-ended, where open-ended funds allow investors to buy and sell units at any time, while close-ended funds have a fixed maturity period and units are traded on stock exchanges. Mutual funds are available in various types, including equity funds, debt funds, hybrid funds, and thematic funds, catering to different investment objectives and risk appetite of investors. So let's understand mutual funds and types of mutual funds. The first type is the equity funds. So this mutual funds invest primarily in stocks and equities with the objective of generating capital appreciation over the long term. The examples could be large cap mutual funds, mid cap funds, or small cap funds. Second, we can look at and understand is the debt fund. Now, these funds invest in fixed income securities such as bonds, debentures, and government securities with the objective of generating regular income or preserving capital. Example could be corporate bond fund, government bond funds, and money market funds. So as you can already see that different types of mutual funds has different objective. Equity fund has a growth objective, and debt fund is more for regular income and preserving capital. Next in line, and which are very famous nowadays in India, are the hybrid funds. These mutual funds invest in a mix of equities and debt instruments with the objective of providing a balanced investment approach. Examples could be balanced funds, dynamic asset allocation fund, and monthly income plans, or MIP. Next type of mutual funds are the thematic funds. So these mutual funds invest in specific themes or sectors such as infrastructure, technology, or healthcare, with the objective of capital appreciation based on the performance of those themes and sectors. Now let us understand what are the difference between mutual funds, PMS, and equities, so that you get a better idea whether mutual funds are suitable for you, or PMS, or equity. First thing is the structure that we need to understand. Mutual funds are managed by AMCs and are available to retail investors, while PMS is a personalized investment service offered to high net worth individuals and institutions by portfolio managers. Equity, on the other hand, is a type of asset class that can be invested in directly or through mutual funds or P. We should also understand how the customization works. So PMS offers personalized investment strategies tailored to individual investors' needs in most cases, while mutual funds have a predefined investment objective and follow a specific investment strategy. Equity, on the other hand, provides direct ownership in a company's. Mutual funds are regulated by SEBI, while PMS is regulated by SEBI but has a separate set of regulation. Equity investments are regulated by stock exchanges and SEBI. Funds typically have lower minimum investment requirements compared to PMS, which generally requires a higher minimum investment amount due to its personalized nature. Equity investment can be made with varying amount depending on stock price, and the investment capacity of the investor. So even the fees vary. Mutual funds charge fees such as expense ratio, entry load, if applicable, or exit load. These charges vary from location to location and different types of investment strategy or mutual funds. While PMS charges fees such as management fee, performance fee, and other charges, which are typically higher than mutual funds. Equity investment may involve brokerage fee and other transaction charges. Now, most important thing is the liquidity part. So mutual fund offer high liquidity as units can be bought or sold at any time, while PMS typically has a lock-in period and the exit can be subject to a certain restrictions. Equity investments are the most liquid, and because equity investment can be bought or sold on stock exchange during market hours. So there you go. That is your one-on-one guide to mutual fund and types of mutual fund and what are the difference between mutual fund, portfolio management service, which is PMS, and equities. So in case if you are looking for any kind of investment, or if you are looking for any more guidance regarding your wealth management service or your creating your portfolio, you can always head over to our website. The link would be down in the description, and it must have flashed on your video as well. And you can just drop in an email to us at info@epkcap.in, and we will get back to you as soon as possible. Till the next video, take care, bye bye, and thank you so much for watching.